Hello, everyone. This is Dr. Kenneth Ta. Today, we are going to consider Chapter 7. Chapter 7 is Corporate Valuation and Stock Valuation. So in this chapter, we are going to learn how we value a company, how we attach price to a company, how we value a stock, how we attach price to a stock. In this chapter, we'll consider the futures of common stock. We'll see how we value common stock, how we use different models to value common stock. The two models that we are going to cover in this chapter is the dividend growth model. We use the dividend in valuing the stock. And then we also have the free cash flow valuation model, where we use free cash flow in valuing the stock or in valuing a company. We are also going to learn how we can value preferred stock. So here we find the two models that we are going to use in valuing a company or stock, the free cash flow model, where we are going to calculate the present value of each cash flow. The business is a going concern, which means the business is there, the corporation is there forever. So if we have free cash flow, the assumption is that the free cash flow or the dividend is going to come in forever. So just like we value any instrument, we understand the pattern of the cash flows, and then we calculate the present value of all those cash flows and we sum them up. So if it is free cash flow, then that will be the value of operations, because free cash flow comes from operating activity of the company. Once we get the value of operation, we can then be able to use that to value stock. We can also do valuation using dividend. Not all companies pay dividend, so that's why it's important to understand the free cash flow valuation model. But for companies that do pay dividend, we can use the dividend in valuing the stock. In that case, we calculate the present value of all future dividend, we sum them up. That is going to give us the value of the stock. All right, common stock owners, directors, and managers. There are some things that are very common as far as common stock is concerned. Common stock just basically represent ownership. It represents ownership. If you hold a common stock, it means that you own a certain portion of that company. So it represents ownership of a corporation. That ownership implies control. It means you have some power to be able to control the happenings of this company. So you are a stockholder, and for many companies, there are many stockholders. So they tend to elect directors that can act on their behalf in hiring a manager that can act as an agent of shareholders. So the manager comes in with the goal to maximize stock prices. So once you own a company, that means you hold common stock, which represent ownership. Ownership means control. There are many stockholders. The stockholders tend to elect a board of directors. The board of directors hire management to run the company on the behalf of the shareholders. So the board of directors can hire and fire management. So management are agents of the shareholders, and their number one priority is to maximize shareholders' worth. And they do that by trying to maximize stock price. We can classify stocks. This is an old classification that is gradually going away, fading away. We can largely classify stocks as Class A or Class B stocks. So class A stocks are usually what is called founder's share, So those who hold this kind of stocks, they are founders. So they tend to have more voting rights than those who hold class B. But there is restriction on the amount of dividend that they can pay. Because again, if they have voting right, they can vote for themselves large amount of dividend. So they have restrictions. So that's the difference between class A and class B. So class A, again, founders share. The owners tend to have more voting rights, but they have restriction on dividend. Class B, on the other hand, the owners have less voting right, but there is no restriction on the dividend that they can receive. All right, we also have tracking stock, which is a concept that is also gradually fading away. But tracking stock, this is the dividend of tracking stocks that are tied to a particular division rather than the company as a whole. So when we talk about tracking stock, there are some shares with dividend that is tied to a particular part of the company, tied to a particular division of the company. So this helps in determining compensation for that division manager. It helps to track how that division in the company is performing. So tracking stocks will basically reflect the activities that takes place in a division within a company, and that division is separated so we can track performance of that division and compensation can be done accordingly. All right, we already mentioned that there are different approaches to valuing common stock, which will really be the heart of this chapter. We have what we call the free cash flow model, and we have what we call the dividend growth model. So these are the two types of model that we are going to use in valuing common stock. Now, in doing this, we need to understand the pattern of the flow of free cash flow or the dividend growth. So free cash flow or dividend can be in such a way that the growth is constant. In that case, we'll use the constant growth method in valuing the company. So by constant just mean in terms of free cash flow, it is growing by a certain percentage period after period, maybe 2% period after period. So that will be a constant growth rate. Or dividend is growing by constant percentage period after period. We can also have the case for which the growth is non-constant. Maybe year 1 to year 2, there is a 5% growth, year 2 to year 3, 2% growth, year 3 to year 4, 5% growth. And then eventually it can become constant. So in that period where we have non-constant growth, there is another way we take our time in capturing the value of the company around that period. So the two approaches to valuing common stock is what we call the free cash flow and the dividend growth model. All right, so we are going to start with the free cash flow valuation model. In the free cash flow valuation model, we are going to use the weighted average cost of capital as the interest rate. So the free cash flow, we had mentioned, that is the cash flow that is available for distribution to all of the company's investors. And the WACC is the overall rate of return that is required by all of the company's investors. So the free cash flow model, we are basically calculating the present value of all free cash flow. So the interest rate we are going to use is the overall rate of return, what we call the WACC, the weighted average cost of capital. All right, so we had mentioned that free cash flow comes from operating activity of the firm. So when we calculate the present value of all free cash flow, what we have is what we call the value of operation, the value of operation. So VOP, the value of operation. And in obtaining the value of operation, again, is the present value of all free cash flow. So when we did time value of money, we said present value is equivalent to the future value divided by 1 plus R raised to the power N or raised to the power T for time. So if we have free cash flow, we are taking the free cash flow because that will be the future value divided by 1 plus the interest rate we just said is the WACC raised to the power T. But we have free cash flow year 1, year 2, year 3, so for different time period. So this is the present value of each of those cash flow, but we are taking the sum of them, we are adding them up. So when we do that, what we have is what we call the value of operation, the value of operation. And then we'll do a little bit of adjustment to be able to get the intrinsic or fundamental value of the company or the value of the stock. All right, sources of value, sources of value. So for a company, sources of value, it can be value of operation, or the company can get value from non-operating assets, So value of operations, this is the primary source of value for most companies, is the primary source of value for most companies. And then value can also come from non-operating asset, is the secondary source of value, and it comes from non-operating assets, especially financial assets. So this can include things like T-bills. So in other words, these are short-term investment and other marketable securities. Short-term investment and other marketable securities. So an example, I just said, we include something like T-bills. So that is how we get value of a company. So it means that we can now add to get total value. So total intrinsic value, or what we call fundamental value, is equivalent to value of operation plus short-term investment. Because value can come from operating activity or from short-term investments, or what we call non-operating assets. All right, so if we have sources of value, then we expect that there is a claim on corporate value. So the claim on corporate value. So these are the people who own the value of the corporation. So the claim include debt holder, it includes preferred stockholders and common stockholders. So debt holders have the first claim, followed by preferred stockholders, and then lastly, we have common stockholders. Debt holders, these are people that issue debt to a corporation. In case the corporation was winding down, these are the first people that want to pay. And then followed by preferred stockholders. And then common stockholders have what we call residual claim. So they are residual claimant of a corporation, which basically imply that after every other stakeholders that is connected to the company have been paid or satisfied, whatever value is remaining, residual that is remaining belong to common stockholders. So we'll say common stockholders, they have residual claim. They are residual claimant for a corporation. So, which means that we can understand intrinsic value of equity because we know that total intrinsic value, we can look at it from the perspective of the claimant is going to be the value of equity plus the value of preferred stock plus the value of debt. So we can isolate the intrinsic value of equity, which that's what we are interested in if we want to value a stock. So the intrinsic value of equity is going to be the total intrinsic value minus all debt minus preferred stock. Okay, so we can see it on this diagram. So here we have sources of value. Sources of value, which we said will include the value of operations and marketable securities. And on this other side, we have claims on value. So the claims on value will be equity, preferred stock, and debt. Okay. All right, so value of operation, which is, we're interested in the value of operation. It is going to be the present value of all free cash flows. And those free cash flows, they are discounted at WACC. So we use the weighted average cost of capital in calculating the present value of all free cash flow. So in that case, we'll have present value of free cash flow 1 plus present value of free cash flow coming in during period 2 plus free cash flow coming in period 3 up to infinity because the business is assumed to be there forever. So this is really how we can obtain the value of operation. And this is true conceptually. But in reality, it's impossible to find the value of an infinite stream because it goes up to infinity. So we need to use mathematical computation and knowledge to compress this formula down. And it begins with the idea that if we have cash flow that is growing at a constant growth rate, so G is the constant growth rate, then if we have free cash flow for year 1, it is going to grow by 1 plus G raised to the power 1. And that is going to give us free cash flow for period 2. So this makes sense. Again, is the knowledge of time value of money, where we have present value growing by 1 plus R raised to the power T to give us future value. So if this present value is free cash flow year 1, it is going to grow by 1 plus G within a 1-year period to the future value, which is going to be the free cash flow for year 2. So we are using a knowledge of time value of money to see that if the growth rate is equivalent to G, then free cash flow for year 2, it is going to be free cash flow for year 1 times 1 plus G. And then for year 2, free cash flow for year 3, sorry, free cash flow for year 3 is going to be free cash flow for year 2, 1 plus G, which is the growth rate. But we know that free cash flow for year 2, it is going to be, if we look above, free cash flow for year 1, 1 plus G, then times the 1 plus G we had before. So this is going to be free cash flow year 1, 1 plus G raised to the power 2, raised to the power 2. So notice what we have is free cash flow year 3 is free cash flow year 1 times 1 plus G raised to the power 2. So accordingly, free cash flow year T is going to be free cash flow year 1 raised to the power T minus 1, T minus 1. So we can continue to go down this path and make adjustments mathematically, and we are going to arrive at the place for which we have a formula. And that formula becomes this. So this is value of operation at year 0. It is going to be free cash flow year 1 divided by WACC minus the growth rate. So all of this is equivalent to the present value of all those future cash flows. So we use mathematical computation and we end up with the value of operation to be equivalent to free cash flow year 1 divided by WACC minus the growth rate, all right? So once we have this, then we can add that to short-term investment to get our total value, which we are going to see. All right. So notice that from this formula, we have this to the power 1, which is equivalent to free cash flow 0, which is free cash flow right now. Free cash flow 1 means free cash flow 1 year from now. So 1 year from now, it can be 1 plus G, okay? WACC minus GL. So it's the same thing. So either we use this or we use this, is the same thing. Okay? Because what we find here is that this now is to the power 0 times 1 plus G. So this is the model that we are going to use to calculate the value of a stock. But first, what we are obtaining is the value of operation, and we are going to add short-term investment to get the total value. If we have the total value, we can easily get the value of equity, which is where we are going. Okay. All right. So this is an example data for free cash flow valuation. So we can use this example. All right. This example suggests to us that the free cash flow times 0, which means the free cash flow right now is 24 million. The interest rate WACC is 11%. Free cash flow is expected to grow at a constant rate. So the rate of growth is 5%. Short-term investment is given as 100 million. Debt is given as 200 million. Preferred stock is given as 50 million. And the number of shares outstanding is 10 million. So with this, we can calculate the value of operation. Okay, so the value of operation is equivalent to free cash flow 1 plus the growth rate divided by weighted average cost of capital minus this growth rate. So we can easily get the value of operation. The free cash flow right now is 24 million. 1 plus the growth rate is 5%. So this is 0.05 divided by WACC is given as 11% minus 0.05. So this is going to be 420. So if we do that, we are going to get 420. All right, so the next slide, we substitute all of that, and just as we have seen, we have $420. So notice that this $420 is the value of operation, but we are interested in the value of equity. So if that is the value of operation, then we are going to add short-term investment. We are going to add short-term investment. So we know that the total value is equivalent to value of operation plus short-term investments. So in this case, the value of operation we obtain is 420 million plus. We were told in this question that short-term investment is 100 million. So we are going to take plus 100 million. So that is going to give us a total of 520. So that gives us a total of 520 million. So this is the total value. That's the total value. And if that is the total value, then we can easily calculate the value of equity. We can calculate the value of equity. So we know that value total is equal to the value of equity plus the value of preferred, 1F, the value of preferred stock plus the value of debt. Okay, so these are the claimants, equity, preferred stock, and debt. So we're interested in the value of equity. So we have just computed total value. If we go back to the problem, notice that we're given the value of debt as 200 million, and we're given the value of preferred stock as 50 million. So accordingly, we can substitute everything, and what is missing is equity, and we can calculate equity. So the value of equity, accordingly is going to be the total value minus the value preferred minus the value of debt. And we did the total value, which we said is 520, and that 520 came when we took the value of operation plus short-term investment. So now we are going to subtract the value of debt, which is given as 50, minus the value of preferred stock. Sorry, the value of preferred stock, which is 50, minus the value of debt, which is 200. So that will give us the value of equity as 270. So 270 is the value of equity, but we know that we have, so this is the value of equity, we have 10,000 shares outstanding. So we go back to the problem. Number of shares outstanding, sorry, is 10 million. 10 million shares outstanding. So we divide this 270 million by 10, and we have the price, which is going to be 27. So that is going to be 27. So this is really where we want to be. So this is how we solve this problem. So we've been able to value equity for this company or calculate the price of this company. So again, it is because, or it is that we are using the free cash flow. So if we are using the free cash flow, we are going to calculate the value of operation, which we have seen by taking the present value of all those future cash flow, and the formula summarize that for us. Once we get the value of operation, we can add short-term investments that will give us the total value. We know the total value, so we know the claimants to this total value, which is equity holders, preferred stockholders, and debt. So we can calculate the value of equity. Once we have the value of equity, we divide it by the number of shares outstanding. That is going to give us the price. So given what we know about this company, if I was to buy this company, I will buy it for $27. So $27 per share is a fair representation of the company. So that is the case for which cash flow grows, but it grows at a constant rate. So we are going to look at the case for which there is growth, but that growth has a non-constant growth rate. It is non-constant. So an example could be projected free cash flows in such a way that cash flow for year one is negative 10 million. For year two, it is 20 million. For year three, it is 35 million. So notice that this cash flow growth is non-constant, is growing at a non-constant rate. And then we are told that after that, it maintains a constant growth rate of 5%. So after 3 years, the growth rate becomes 5%. So how can we value this company? How can we value this company? Okay. So we can do a forecast of this free cash flow, and then we can see that the growth in free cash flow is not constant during the forecast period. And then we can easily calculate the value of the company for the time for which the growth rate is constant. So this is the timeline of the free cash flow. Again, the first 3 years, free cash flow is non-constant, negative 10 million, 20 million, 35 million. And after that, the growth rate becomes constant. So if the growth rate becomes constant after that, it means that free cash flow for year 3 is going to grow by GL. And then for year 5, is going to be free cash flow year 3 growing by GL. For year 5, it is going to be free cash flow year 4 growing by the growth rate, and so on and so forth. All right, so we're interested in calculating this free cash flow. So what we are going to do is we are going to do the free cash flow for the period for which the growth is non-constant. We are going to calculate that one at a time. We calculate the present value of those non-constant free cash flows and add them up. And then for the period for which it becomes constant, we'll use the constant model in calculating the value. So if we look at this, we are going to calculate the value at year 3 that is going to capture the free cash flow for year 4, year 5, year 6, up to infinity. Okay, so this value at year 3 is what we call the horizon value, We can also call it the terminal value, or we can call it the continuing value, Okay. So if we go back to the model that we just used in calculating free cash flow, the value of operation at time t, it is going to be free cash flow at time t, 1 plus g divided by WACC minus g. So this is the formula we used before, but we're calculating the value of operation at 0. Now we can calculate the value of operation year 3 that will capture the free cash flow for year 4, year 5, year 6, up to infinity. Okay. So for us to do that, if we follow our knowledge of before we said the value of operation, of course, at time 0 is going to be the free cash flow at time 0, 1 plus g divided by WACC minus g. So now the value of operation at period 3, it is going to be the free cash flow year 3. So notice when we had 0 here, we had 0 here. So if this now is 3, this is going to be 3, 1 plus g over WACC minus g, Okay. So this is going to give us the value of operation year 3, again, which captures the cash flows that come in year 4, year 5, up to infinity. Okay. And we are able to do that. If we do that, then we can get the value of the horizon value at year 3, which is going to be the free cash flow year 3, 1 plus g. So the free cash flow year 3, based on the problem, we are told that is 35. The WACC is 11, G is 5%. So we have the 35, 5%, and 11. So this is 0.11. And if we multiply that out, we are going to end with 612.1. So that will give us 612.1. Okay. But it is important for us to note that this is just the value of the cash flow for year 4, year 5, year 6, and so on and so forth. So this is what we have calculated, and here we have 612.5. So again, it represents the value of cash flow for year 3, year 4, year 5, up to infinity. So for us to get the value of operation at time 0, which is right now, we are going to take each of these cash flows that we had before. These are the irregular cash flows. Calculate their present value, and then we sum them up plus the present value of this horizon value. And that is going to give us the total value of operation at time 0. Okay. So this is what we had before. Then we are going to take each of those abnormal cash flows and calculate their present value. So for the first one, we know that present value is future value divided by 1 plus R, which in this case we are using WACC raised to the power T, raised to the power T. So the first one is 10. So this first one is 10 over 1 plus 0.11 raised to the power 1. And this is minus 10. So when we do that, we have minus 9.009. And then we do for the second one, which is 20. We do for the third one, which is 35. So now we have this, and then we have 16.232. Then we have 25.592. Okay. So those are present value. We also calculate the present value of this horizon value, which is going to give us 44.785. And then we sum them up. Once we sum them up, this gives us the value of operation at time 0, which is the value of operation of the company. Okay. So if that is the value of operation, then we can add short-term investment. So this is the value of operation plus short-term investment. This gives us total value. If this gives us total value, then we can calculate value of equity. We simply subtract debt and we subtract preferred stock. This will leave us with value of equity. We divide by number of shares outstanding, and we have our price, which is going to be 33.07. And this is where we want to be. So this is how we are going to value this company. And again, this is for non-constant growth. So once we have non-constant growth, we are going to calculate the horizon value. That is for the period for which growth is constant. And then we calculate the present value of the different cash flows for the period for which the cash flow was non-constant, plus the present value of the horizon value. So once we add that up, as we have seen, we now end up with the value of operation of the company. If we have the value of operation, we added the short-term investment, that gives us the total value. If we have total value, we subtract debt and we subtract preferred stock. That gives us the value of equity. The value of equity, we divide by number of shares outstanding. That gives us the price, which is where we want to be. So that is how we value a company using the cash flow model. All right, the other model we want to look at is the dividend model, how we value the company using the dividend model. Okay. So this is where we are. So this is value of dividend paying stock. So we are going to take the present value of dividend discounted at the required return. So we use the same kind of concept. We have dividend that is being paid by this company. So we assume that the company is a going concern, which means that it's there forever. So dividend is going to be paid forever. So we have dividend year 1, year 2, year 3, and so on and so forth, up to infinity, up to infinity. So for us to calculate the price right now, which is what we are interested in, we take the present value of all this dividend and we sum them up. Again, this is conceptually correct, but it is impossible for us to calculate the present value of an infinite stream. So we are going to use mathematical computation to summarize the formula, which is not something we need to know how it is done, but it begins from the idea that if dividend grows at a constant growth rate, then if we have D0, which is the dividend that has just been paid right now, it is going to grow by G, the growth rate, raised to the power 1 to give us D1. So we have seen this kind of stuff before. Again, future value is present value 1 plus R raised to the power T, raised to the power T. So if this present value is the dividend right now, it is going to grow by this dividend 1 year from now, and it will be by this growth rate 1 year from now raised to the power T, which is 1. Okay, so that is how we obtain D1. Then we can get D2. D2 is going to be D1, 1 plus G. So the same kind of argument, D2 will be D1, 1 plus G. But we know raised to the power 1. We know that D1 is D0, 1 plus G. And then we had 1 plus G before. This is D0, D2. So that means that D2 becomes D0, 1 plus G raised to the power 2. Raised to the power 2, which is what we have. So we can generalize it if we have 1 year raised to the power 1, if we have T year raised to the power T. All right, then we bring that in and we work our way until we come to a model that can help us to value stocks, which is the constant dividend growth model, the constant dividend growth model. And this is what we have. This is the main formula that we are going to use to value stocks when dividend is given and dividend grows at a constant rate. So it's basically going to be D1, which is dividend that will be paid 1 year from now, divided by R, which is the interest rate or the required rate, minus G, the growth rate. And D1 again is equivalent to D0, 1 plus G. And then we divide that by RS minus G. Okay. So we can now start trying to calculate the problem. In some problems, the required rate S is going to be given. So notice that when we use the free cash flow model, we're using WACC as a required rate. But when we are using the dividend model, we are now using the required rate of return. And we go back to the security market line or capital asset pricing model, and that will help us to calculate the required rate of return if not given. So before we had looked at CAPM. CAPM is the same thing as security market line, which implies that the required return of stock is equivalent to risk-free rate plus the beta coefficient times the risk premium, which is RM minus RF. So this is the risk premium. So the risk premium, the market risk premium. All right. So in this case, if a company's beta coefficient is given as 1.2 and the risk-free rate of return is given as 7, the market risk premium is given as 5%, then we can just substitute that to calculate the required rate of return. So if we substitute that, the risk-free rate is 7, market risk premium 5, the company's beta coefficient 1.2, that will give us a required return of 13%. So if that required return of 13% is given, or instead of having that, if we have the company's beta coefficient, the risk-free rate, the market risk premium, then we can calculate the required return. So if we have the required return and we have the dividend that has just been paid, D0, which is equivalent to 2, and we have the growth rate, which is 6%, so dividend is growing at 6%, we can easily calculate the price or the value of the stock. So using the growth rate method, the formula is this. So P0 is D0 1 plus G divided by RS minus G. So this is 2, G is 1 plus G is 0.06 divided by 13, which is 0.13 minus 0.06. That will leave us with 30.29. So this is where we want to be. So this is the value of the stock, estimating intrinsic stock value. And this is using the constant growth model. Another name for the constant growth model is what we call the Gordon's model. The Gordon's model, after the name of the person who founded this model, Mr. Gordon. Okay. All right, so we can look at some things here. We ask what is the expected price in 1 year? What is the expected price in 1 year? So we were given before that D0 is $2. So in 1 year, what would D0 be? So in 1 year, D0 is going to be D0 1 plus G, of course, raised to the power 1, right? So this is going to be 2, 1 plus G, which is 1, G is 0.06 raised to the power 1. So that is going to be 2.12. So this is actually D0 1 year from now. which means we're interested in calculating the P0, but take note that it's 1 year from now. So 1 year from now, this is D01 plus G over R S minus GS. So this is going to be equivalent to D0 1 year from now, which is 2.121 plus the growth rate, which is 0.06, divided by RS is given as 0.3 minus the growth rate of 0.06. If we do that, then we'll end up with 32.10. 32.10. So what is the expected stock price in 1 year? It is going to be 32.10. 32.10. All right. A couple of things. We can make money in the company through what we call the dividend yield or the capital gain. So if we are receiving a dividend, then that is one way we are increasing our profitability. Or we can also make money through what we call capital gain. So which is the appreciation of stock prices. If stock price is changing, then if it's going up, shareholders in the long position are making money. So dividend yield is basically the dividend received divided by the price. Capital gain, it is change in price, which is the price right now minus the past price divided by the past price. So D1 is given as 2.12, P1 is given, P0 is 30.29. So that gives us a dividend yield of 7%. So initially, this was the price. We have moved from 30.29 to 32.10. So divided by 30.29. So we end up with a capital gain of 6. And this makes sense because our capital asset pricing model shows that the required rate of return was 13%. So if we add this and this, that gives us 13%, which is our total return. So total return is dividend yield plus capital gain. And the total return is 13 because the dividend yield is 7, the capital gain is 6, so that gave us 13%. And that is equivalent to our total return, which is the required return based on CAPM. All right, so we've seen how we can value a company, the case for which growth is constant. Let us look at the case for which we have non-constant growth. Non-constant growth. So for example, non-constant growth of 30% of year 0 and year 1, 25% from year 1 to year 2. So 30% for year 0 to year 1, 25% growth. For year 1 to 2, 15%, for 2 to 3, and then long run, there is a constant growth model of 6%. All right. So for us to do this, we can put this on a timeline. If we put this on a timeline, we can see that the growth rate is going to vary. So it's 30%, 25%, 15%, and then 6%. So we'll use the same knowledge where we are going to calculate first the different dividend, And then once we calculate the dividend, we calculate the present value of each of those dividend. And then we calculate the horizon value. We calculate the present value of the horizon value. We add them up so that we can get the present value right now. Okay. So the dividend that was just paid, D0, we are told is 2%. And then it is going to grow by 13%. So which means that at year one, we want to get D1. D1 is going to be equivalent to D0 times 1 plus G. And the D0 is 2. 1 plus G is going to be 1 plus 0.30. And once we do that, we are going to get this. And then we come to the next one, which is D1. So this is 2.6 times 1. Now the growth rate is 25.25. And we are going to get this. And then this one, so we are calculating the dividend. So this is dividend year 1, this is dividend year 2. So now we calculate dividend year 3, which is going to be equivalent to dividend year 2, which is 3.25 times 1 plus the growth rate, which is now 15%, 0.15. And that is going to give us 3.7375. All right, so now we calculate the horizon value. We calculate the horizon value. So we can stand at, here, horizon value. And calculate the P3, which is going to be equivalent to D3, 1 plus G divided by RS minus GL minus G. Okay, so we are able to obtain D3, which we did, and we had 3.7375. 1 plus G, we are now told that there's a constant growth rate, which is 0.06 divided by 0.13 minus the growth rate, which is 0.06. Okay, so once we do this, we'll end up with P3, which is 56.59. And then we are going to now calculate the present value. So what that means is that P0 is going to be the present value of D1 plus present value of D2 plus present value of D3 plus present value of P3. Okay, So we have D1, we calculate the present value. So D1 is 2.6, the present value, which is divided by 1 plus 0.13 raised to the power 1, and that is going to give 2.301. Okay, so that's how we obtain this 2.301. So that's the present value for D1. Present value for D2 is going to be 2.545, present value of D3, then present value of P3. So P3, again, we have used the growth model for P3, which means it captures the value of the company P4, P5 to infinity. So once we sum up everything, we end up with 64.44. So that will be the price, that will be the value of the stock. So this is how we value a stock when there is non-constant growth in dividend. So we treat the period for which there is constant growth using the Gordon's model, and then we calculate the present value of each of those cash flows for the period for which there was non-constant growth. And we add that up with the present value of the horizon value. That is going to give us the price of the stock, the price of the stock. And again, we can break it down to dividend yield and capital gain. Dividend yield is D1 over P. Capital gain is change in stock price. And that is going to give us 5.6 and 7.4. All right. The last thing we want to talk about is preferred stock. Preferred stock is a hybrid security. It's very similar to bonds, but unlike bonds, preferred stocks tend to preferred stocks, unlike bond, preferred stocks dividend can be omitted without fear of being pushed into bankruptcy. So one thing we know about preferred stock is that it is a fixed amount because it has this bond characteristics. It's a fixed amount that is being paid period after period after period. The amount is fixed, which means that the growth rate is zero. The growth rate is zero. So notice that in valuing a stock, we're interested in P0 based on the constant growth rate model. It is D0, 1 plus G divided by RS minus G. Oh, which is the same as T1 over RS minus G. All right, so but for preferred stock, the growth rate is zero. So the dividend does not grow. It's the same dividend. Preferred stockholders receive the same dividend period after period after period. So it means that G is zero. So in reality, the value of P0 for preferred stock is basically going to be the dividend divided by the required return for preferred stock. So that's why we say it is basically the value for the stock is basically the dividend divided by R. So if we look at this, the growth model, this G is zero. So it's basically G divided by R. So if we are given an example for which the dividend is $2.1 and the required rate of return of preferred stock is 7, and we are asked to value the stock, the value of this preferred stock will basically just be 30. It's going to be 30. Right, so that brings us to the end of this chapter. Thank you.